We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bob Thompson, author and senior portfolio manager at Raymond James, and also Larry McDonald. Larry is a New York Times best-selling author and also the creator of the Bear Traps Report. Larry and Bob, welcome to the show. How are you guys?
Hi, Tom. Happy New Year.
Great to see you again, Tom and Larry.
Hey, Bob. Good to see you, man.
Great to have you both on the show today. And we were going to do a bit of a team, let's say, talk here. You guys speak often. And I find it quite interesting because, Larry, you bring so much of the macro side of things, and Bob, you bring so much of the, let's say, the more focused investing side of things. And I think this is going to be a great dynamic to combine here. And I'd like to start by talking about kind of the trend of inflation right now. Where is it heading in the G7? And, over the last 2 years, how have we seen that really change?
Go ahead, Larry.
Well, thank you, guys. One of the things we talked about in our first book, Colossal Failure of Common Sense, the Lehman story, the fiscal and monetary response to Lehman was $4 trillion. The fiscal and monetary response to COVID, plus the regional bank crisis of 2013, and plus, the juicing of the fiscal lever into the election is over $16 trillion. 16 trillion. So just think about the last 4 or 5 months. We get 100 basis points of rate cuts from the Fed. Team Biden into this election, on the way out the door, they increased spending almost $800 billion. We're finding out this week 40% over last year. And so that's just in one quarter now. So what's interesting is Trump comes in, the first quarter of the year belongs to Biden, right? And so you get 100 bips of rate cuts, 50 on the first shot. Into at the same time the Fed was cutting rates 100 basis points, the Fed was juicing, the Treasury and the White House was juicing fiscal max all in. At the same time, you've had the strong dollar, which is juicing inflation around the world. So let's just say you're in the UK. Your pound's down 9% since September, but your energy costs are up 50% on nat gas, 16% on oil. And today's CPI data does not include the recent move up in energy. And so we're in a very dangerous spot for inflation, because the probability that we go into some type of small hyperinflation period like 2022 is extremely, extremely high.
They say history doesn't repeat itself, but it rhymes, right? So everybody's kind of looking at the analogies of the 70s, and it is interesting because, you look at these charts where inflation rose, went down, and then rose significantly again. But things, things are a little bit different. They aren't exactly the same. And, we can't raise interest rates the way we did before, right? Or the Fed can't raise interest rates to beat inflation. So it's interesting what's happening is the market kind of sees how much debt has to be rolled over, what inflation is going to do to bonds, and the market's kind of doing it for the Fed, right? You look at 10-year yields, the first time really ever that they've absolutely surged after the Fed started reducing rates. That's not normal. It's not healthy. It's not healthy with this sort of debt. And I think Larry mentioned, $26 trillion of issuances this year because of a lot of 3-month paper and things like that. The market just can't take it.
Yeah, people don't realize. So in 2024, there was 26 trillion of T-bills and bonds issued. And so what's happening is, and we saw this when Clinton was leaving office and the Bush team was coming in 2000, the Clinton team, Bob and Tom, they took all the W's off the keyboards in the White House. It's a classic because, George W. Bush, they took every keyboard in the White House, they took the W off. And so when the Bush team came in, they had keyboards across the entire White House without any W's. And the same thing's going on here in the sense that Biden is juicing the fiscal, like I said, 40% up year over year. So he's actually taking fiscal, I guess, flexibility away from Trump because we have the debt ceiling. And so in 2025, at the same time, like you said, Bob, 26 trillion of T-bills and bonds were sold that last year. And all that means is you're issuing a lot of 6-week, 8-week bills, 3-week, 4-week bills, and you're over and over and over again. Now the Trump team, Tom and Bob, the Trump team has to term this debt out because we're issuing 2 standard deviations more. It's like a junkie that's living in the trailer park that's living off of a 1-month credit card. And so we're issuing the T-bills, we're financing the entire debt. So most of the 25%, guys, 25% of U.S. debt comes due this year, and 40% of that is in the first quarter. And so it's upwards of $8.5, $9 trillion. So the bottom line is a lot of those shorter term 3-month bills, 1-month bills, they have to be sold to investors longer term. That puts more pressure on the long end of the curve. And that's what's starting, as you can see, over the last 8 weeks, last 4 weeks, the market's not acting well because we're trying to digest this huge bond problem.
And if I was to highlight Larry's analogy there, when you give somebody something to give them a high or whatever the case is, obviously you have to continuously give more to keep that static state, right? And that's why things obviously get very perilous as time goes on, and you see that happening in with the debt, right? Because just another trillion or 2 trillion or 3 trillion doesn't get things any better. That just remains the status quo. So then you have to keep adding more and more and more onto that, and that's how you evolve in this in this debt cycle and debt process, where ultimately you have to. People lose confidence in the currency, and they haven't done it yet with the U.S. because they can print money and it's the reserve currency, and that's great. Other people can't do that, but sooner or later you get to the point where you have to tie your currency to something hard. I'm not saying we should have a gold standard, but it's got to be something that people can say, okay, well, the currency equals this, right? Mm-hmm. So, and this is a very stable asset, and that's what they did in 1944. That it kind of ended in 1971, right? And here we are on this trail since 71, and we've evolved in the process. But from 44 to 71, it was the system worked okay until it didn't, until people wanted their gold. And then Nixon said, well, we can't, obviously we don't have enough gold to tie that to the dollar, so we're going to decouple from the dollar. And this is just a normal stage. And I think Dalio talks about that. You can't get to stage 5 unless you went through stage 1. It's kind of like cancer, right? You got to go through stage 1, stage 2, stage 3, and and we're getting up to stage 3, 4, 5 of stage 6 right now, and you start to see extraordinary things that the Fed's trying to do, right? I mean, nobody had ever heard of QE, right? But then QE came along, and now QE is just an everyday term. Everybody knows QE. So I think Larry's mentioned we're going to go from QT. Maybe we're back into QE. We're going to have to do that in the next few months because the dollar's up, because that's hurting other. Trump's America first. I understand that, but obviously you can't have a wrecking ball for the rest of the world without it coming back and hurting the U.S. So I think if we it's interesting, the dynamics. If you look back at the big picture again in 2000, we're in a similar sort of situation to 2000 with regard to stock flows, with regard to where commodities are, with regard to NASDAQ, with regard to bubbles happening. And, the US dollar peaked, DXY peaked at about 120 back in 1999, 2000, right? And then it peaked at 114 again in 2022, went back down below 100. Now we are up around 110 again. So it's interesting, within a channel, maybe you get a triple peak there. And, that's telling you that we're probably going to go in the other direction. And Larry talks about this a lot, and I think it's very important. It's very important for your listeners, Tom. It doesn't matter what's happening in the market. What matters is what the market thinks is going to happen from there, because whatever is happening in the market up until a second ago is already factored into the market, right? So as Soros says, the best way to make money is be on the opposite side of the ship from the consensus, be completely non-consensus, but then be right, right? So how do you be right in the short term? You can't necessarily, but if you're patient, let the market come to you, you'll be right if you're on the opposite side of the ship.
Well, we'll get to that, let's say that time analysis or that time arbitrage in a bit, Bob. But Larry, I wanted to ask you if financial conditions are actually easier now than at the time when the Fed started to cut rates, and did they really make a mistake by cutting by 50 basis points and pumping more liquidity into the economy?
Yeah, we just did a chart. It's on Twitter. And what it measures is the sentiment from business owners around America. The NFIB survey shows that expectations of financial conditions and the way business owners feel, they feel that financial conditions now are easier than when the Fed started hiking. And I want you to really sit back and digest that, because it's a huge, colossal.
Sorry, Larry, started hiking or started cutting?
I'm sorry, started cutting rates. Yeah.
Okay.
Started hiking. So in other words, we started the beginning of the hiking cycle and we just ended the hiking cycle. So from the beginning of the hiking cycle to the end, so that's over the last year and a half, the sentiment from business owners and the NFIB is that they feel like financial conditions are easier now than when they started. See, typically the way it should work is after a hiking cycle, financial conditions should feel violently tight because the Fed's trying to slow down inflation. But this time around, they hiked rates 100 basis. They hiked rates more than, obviously, I think it was 500 basis points. And from the moment they started hiking, financial conditions from a survey point of view feel easier now. That basically tells you that we have a big inflation problem, because if financial conditions are easier after you hiked, then that's going to really feed into prices. That's what you see. Look at the ISM prices paid. You look at all the leading indicators for inflation. There's a big top kind of mean reversion in inflation coming very, very soon. And there you can see it there.
Yeah, we just put it up on the screen. So the light blue shading is right when the Fed started to tighten, and that purple line is expected credit conditions.
Yeah, so you can see here we're easier now than when we started hiking rates. This is so inflationary because business owners are spending money, and it's like a scene from the Terminator, guys. You know, you can't stop that. The hand keeps coming back. Inflation gets. I talk about this in our book, How to Listen When Markets Speak. Inflation gets under the seat cushions. It gets under the carpet, and you can't get rid of inflation without at least 5, 6 to 10% unemployment.
So is it possible that, that optimism that we're seeing by business owners, and also the optimism that we're seeing in the US stock market is, very misplaced at this time?
Well, what happens is, like, we saw this with Reagan and we've seen it in other elections. As before, when markets are expecting a market-friendly candidate, they run up into the expectations of the election. And so when Reagan won, the equities were up 46% into the Reagan win. It's the same thing now, where a lot of that deregulation goodwill is priced into the market. But when you talk to people, I'm going to bring everybody behind the curtain. So we run a Bloomberg chat behind us, and we're very close with people in the Trump team. Most of our clients are hedge funds, mutual funds, pension funds. And I can tell you one thing. Since mid-September, Scott Bessent, the incoming Treasury Secretary, has been meeting with all kinds of institutional investors in private settings. And he's been laying out the tariff plans and all these things. And that's why the dollar has gone up so much, because they've kind of been tipping their hand. But when you talk to people inside the Trump team, they're very unsettled about the move up in the markets, because there's some tough things they have to do around tariffs, around terming out the debt. In other words, they have to issue a lot more long-dated bonds. And they want to do that as far away from the midterms as possible. Way, way, way. So the probability that the market's priced in, like Trump is potentially very, very bullish over a 4-year period, but we're priced in a lot of that. And the difficult things they're going to have to do, the United States is like a 650-pound woman or man that needs an entire liposuction, operation. And so there's some very difficult things we need to do, and the market's not acknowledging those things. The market's really looking, way, way out into the future in terms of what Trump can deliver and deregulation, all that stuff. But in the meantime, there's some pain to take, and it's going to we're probably going to start taking the pain here in the first quarter of 25.
Remember, Tom Besant said he, wanted the job because he wanted to be part of this kind of structural change that was going to happen with the dollar. He sees kind of a generational change, and he wanted to be part of that. And interesting enough, if before he knew he was going to be Treasury Secretary, he did see an interview he did a few months ago that said one of his top holdings was gold, right? Because he thought that was for his hedge fund. Obviously, he's not going to talk that way now. He's obviously can't talk that way now. But I think he sees what's coming, and we really can't control it. He just wants to guide the path along to in a way that he thinks is best, and that's why he wanted the job, because it's tough to get quality people that have been very successful in their lives to come and run government, right? It really is. Now, if they think they can make a difference, then they're going to go do it, and I think that's what he's going to do. We'll see if there's some frustration from the top on that, but again, just what Larry talked about with Ronald Reagan there. Interest rates went up dramatically. As we know, Reagan got elected in 80. And then I think it was the famous Barron's article in 82 that said stocks are not worth investing in anymore, right?
Yeah, it took 2 years, guys.
Right.
From the moment Reagan was elected, it took 2 years to get back to even.
Mm-hmm.
And so, but in the end, the market finished the 4-year term, Reagan's first 4-year term, up a lot.
Mm-hmm. And interesting enough, small caps came back, and that's something we can talk about too. How small caps have been dead for a long time, and that's a big factor here in Canada because there's a lot of small caps in the mining space. But obviously, these changes hopefully are going to bring small caps back. And Peter Lynch was the best portfolio manager ever for many, many, many years. It just so happened he started running money right at this time when small caps became big winners, and it helped him a lot. So I think when you hear people talking about the fact that large caps are always going to be the best, small caps are never going to perform, the more people pound the table on that, the more excited I get about small caps and the other side of the trade.
Mm-hmm. Well, Bob, I remember listening to that interview with Scott Besant about gold being his largest holding, and that kind of blew my mind that he admitted that very, very openly and candidly. But it makes me wonder, back to this idea of this strong dollar and what that ends up meaning for Trump and his team. They want the dollar to be competitive, and that realistically means a weaker dollar. So, does this strength actually kind of threaten their goals, the dollar's strength, threaten their goals, and how do they go about, weakening the dollar to achieve those aims?
Okay,
he's trying to say two things, right? He said we want a weaker dollar, but unless you use the U.S. dollar as your reserve currency, we're gonna tariff you unless you buy from. So it's kind of alternating things, but I think they'll figure out their path. Let Larry talk.
But so this is very interesting. When you talk to people, I talked to someone yesterday who's very, very close with the Trump team, and there's basically two tribes forming. So there's the Don Jr. tribe with JD, and remember, Don Jr. was the one that was pretty much responsible for choosing JD Vance. And remember, JD Vance comes from kind of the Rust Belt. There's a famous book that JD Vance's life is based off of, and it has a lot to do with the decimation of U.S. families. Life expectancy has crashed. Like we talk about this in our book, in many parts of the United States, that are dollar sensitive states in terms of the economy. And we've decimated the Rust Belt, right? And so there's no question that there's a part of the Trump team that's very upset with Bissett in the sense that he's gone out there, he's talked to hedge funds, he's told people about these tariffs, and that on expectations of that, people are bidding up the dollar. In 2016, a similar thing happened when Trump won. The dollar ripped, and then Trump came out 2017, late January, early February 2017. After Trump won, he came out and started talking the dollar down. Now, this time around, when you talk to Bissett, and we know we have clients that were in these conversations, here's what, because they say this, like, listen, a strong dollar is not good for Trump's base. Eventually, you're going to really annoy the president. And what he says is, what we're going to do with the tariffs is we're going to go, okay, we're going to say to Mexico and Canada, the 25% tariff starts in September of 2025. You have this many months to either either put factories in the United States or buy U.S. products. Same thing with China. In other words, buy U.S. natural gas or take a factory and put it into the United States. And so what's happening is a lot of this is strong dollar stuff is way out in the future, and the tariffs might not ever come. But Bissett thinks that over time, and he's right, over time on a chalkboard, it's potentially good for the dollar, right? Because you're going to have a whole bunch of countries buying either U.S. assets or buying natural gas or buying soybeans or taking a manufacturing facility, moving it to the United States. We get that. But in the short term, when the dollar moves higher, and all of this is very, very disruptive, and it hurts in the near term. It decimates U.S. manufacturing, exports. Right now, any company that sells products around the world is getting hammered, and this is all going to start to show up in the earnings. That's why just look at Microsoft. Half their sales are outside of the United States. The stock's dramatically underperforming, and so over time, this thesis of the Trump Bissett thesis around the dollar, if you did it for, say, 8 years or 7 years, it would be good for the dollar. But in the near term, you create so much disruption, and you force, because of inflation, you force the Fed back in, like you said, from going from QT to QE and actually buying bonds, and all of this inflation weakens the economy. And so in the near term, it's very, very, I think, dollar bearish. And I think right now, and then we go back once again, I got to remind you, if you're in Europe, the euro is down 10% since September. Gas is up 40, oil's up. So if you're an oil importing country with just massively increased inflation in Europe and in the UK and in Japan, and guess what? Those central banks now have to be, so the last 6 months, the Fed's been more hawkish than the global central banks. But when we export inflation around the world because of the strong dollar, now all of a sudden the global central banks have to be as hawkish as the Fed. That's a dollar negative. So the probability that you get a big dollar reversal, which is good for metals this year, I think is very high.
And remember, Tom, that the cure for a high dollar is a high dollar, right? The cure for high interest rates is high interest rates, and the cure for high commodities prices is high commodities prices, right? Everything readjusts back to a range, and that's why we can talk about this in a bit. But that's why I'm a really big believer in ratio charts. Gold to S&P, gold to silver, gold to gold, whatever the case is, right? And when you get these big 2 or 3 standard deviations away from the norm, I think, and we could talk about that more, but that's a real good asymmetrical return profile, right? Your downside's fairly little and your upside's big, and all you have to do is be patient. And you look at, Larry's read a lot on Paul Tudor Jones and probably knows him, but Paul Tudor Jones just said, in one of the best traders ever said in his career, he says I've done well in lots of things, but he said I've made the most amount of my money at those capitulation events or at the euphoric events, and identifying those and taking the opposite side of the trade. Because again, very asymmetrical, minimum downside, big upside when it reverts to the norm. And I think that's what we're talking about here with the dollar. right? The dollar goes up too high, the higher it goes, the more you can de-risk yourself to the dollar because it's going to snap back faster, like a rubber band.
Mhm. Well, that I think that leads very well into this next idea, and that's how much gold buying other central banks, particularly China, have been doing over the last several years. And is this shift away from US treasuries a theme that is going to start accelerating more and more and really kind of take away some of that momentum of the dollar?
Well, it's very hard to quantify these things. The World Gold Council, tries to do it. Bloomberg. There's so many backdoor ways that central banks or treasury departments of other countries can do things like this, and we just saw this with oil and all the games. I mean, we're in a war with Ukraine, and just now we're sanctioning, like, the most effective sanctions after 3 years of a war with Ukraine are coming on because Russia has been selling their oil all around the world on these phantom ships, right? So it's extremely hard to quantify. But I would say the spread between gold and platinum and palladium, or gold and silver, is extremely unusual. So it's very clear there's a lot of central banks buying gold. And we get into the book is when you use the sanctions weapon, we call it a multipolar world. When you use the sanctions weapon over and over and over again for 15 years, whether it be Republicans or Democrats, you're forcing other central banks into gold ownership. And gold's a $16 trillion pool of liquidity. Platinum and palladium combined are only 350 billion. Silver is maybe $1 trillion, $1.5 trillion. So global central banks, it's very difficult for global central banks to own other metals besides gold. And that $16 trillion pool of liquidity is why they own it. And in terms of how many bonds they're buying, it's clear they're buying a lot less because, once again, with the sanctions weapon, they don't trust U.S. government as much. Mm-hmm. They just watch Russia put a lot of money into assets that were associated with dollars globally, and that money was just confiscated and given back to the Ukraine. And it's so any government in the world that sees that just going to be a little bit more cautious with their ownership of treasuries, which gets back to the point that we're making here. At the end of the day, the Fed, if you have massive debt issuance where the Treasury has to term out the debt, remember, you have to sell so many bonds this year, and there's so many T-bills that are rolling that when you go to sell them into 5 and 10 and 20-year notes and 30-year notes, and there's not as many international buyers, that forces the Fed to go from QT, quantitative tightening, back to buying bonds with QE, and that potentially is very dollar negative, and that's what probably is about to happen.
And guys, one of the things we haven't discussed with your question there, Tom, is that sure, central banks have been buying, and I think it surprised a lot of people in 2022 that gold didn't crash, right? Because interest rates were going up. Central banks were buying, but it kind of takes two to tango, right? You have to have retail institutional investors buying into gold too, because retail and institutional investors are the ones that buy the gold stocks, right? Central banks don't say, "Hey, I think Newmont's a great stock, we're going to buy it," right? They have different end games. So it's been an interesting scenario. We've seen gold do extremely well, and the gold stocks have really lagged tremendously behind the gold price. And there's a couple reasons for that. I mean, margins are compressed a little bit because inflation, but there just isn't any interest from institutions, from retail in gold. Bitcoin could be a little bit of that, but I don't think it's all of that. And the reason for that is because it's been central banks that have been buying. And the other reason for it is because we have a bubble and a lot of risky things in the US right now. Remember EVs in 2021, right? They were sucking all the capital out. I won't name stocks, but you knew these stocks in 2021, they were going to be the next Tesla, right? Those stocks are down 90% now, but they sucked all the capital at that time. So it wasn't going into other areas. In the last 6 months, the capital's AI has been sucking all the capital into other things. And I can be pretty confident in saying that most AI stocks in the next 3 or 4 years will be down 80 to 90%. from where they are right now, except for maybe the big 2 or 3. But the reason I talk about that is it's sucking capital, right? So capital is not going to, capital doesn't care that gold is $2,700 an ounce and GDX hasn't moved very much at all, because it's not exciting enough. And I just want to talk on this just for a minute again, because it is important. I was reading a portfolio manager recently who talked to a friend of his who was another portfolio manager, and he was absolutely panicking. This was a few months ago. And why was he panicking? Because he didn't have a full weight in NVIDIA in his portfolio, and he was lagging the index. So he said, I gotta increase my NVIDIA weight. I gotta increase because I gotta chase the index stocks. I must, because I'm lagging. And so I can say that when it's part of a process, and when these portfolio managers get to a full weight in whatever the stocks are that have done the best, that'll probably be the top. And then money will start to go down to other areas. And that works with gold stocks too. At this particular point in time, the allocation to gold stocks is pretty much zero for almost all portfolio managers, even in Canada, believe it or not, right? So someday when gold stocks become 8% of the market, we'll say, or 5% of the market, and the average portfolio manager is a 5% weight in gold stocks, that'll be the top for gold stocks. We're not anywhere near there right now, but there's been lots of reasons why there hasn't been capital allocating to undervalued areas.
Mm-hmm. Well, Bob, as part of that, when fund managers see, let's say, this outperformance of gold relative to U.S. stocks, does this also become, a key signal to bring more of that attention and more of that fund flow into gold and gold stocks?
Fantastic question, and yeah, everybody these days is a momentum trader, right? They're running after whatever's doing the best because there's a lot of things that are doing okay. They're trying to keep up with the index, whatever the case is. So yes, nobody cares that gold was up more than the S&P last year, right? Nobody cares because the S&P was up a lot, but the fact is the gold was up more. So here's another ratio chart that we look at is gold to the S&P, right? So it's done a triple bottom of about 0.4 as a ratio. So again, $2,700 gold, 6,000 S&P. You see the ratio there, right? So that's what we're looking at. So it over the last 2 or 3 years, it's done a triple bottom at about 0.4, but it is in a rising channel. It's about 0.47 now. So gold is outperforming the S&P, just nobody cares or nobody knows yet because the S&P is doing okay. And that kind of resistance level is about 0.48 to 0.5. So once gold goes over that 0.5 to the S&P, that means it's significantly outperformed the S&P. And I think at that particular time, the hedge funds, the momentum traders say, oh, there's a new game in town. We got something that's doing better than what we were in. And the money will start to flow into there. Here's an interesting stat, Tom. I read this the other day. I haven't double checked it, but I believe it to be true. In 2011, the market cap of the GLD was, of GDX was about 40% of the market cap of the NASDAQ ETF. 40% the market cap. Today, that market cap, that was in 2011. Today, the market cap is 4% of QQQ. So that's quite fascinating. It tells you how hollowed out, how underinvested this sector is. And again, if you have patience, I look at that as an asymmetrical return profile. I look at that as not much downside. Couldn't get much worse. And huge upside. And when this happens, it happens big, right? To any particular sector. When people's eyes come to the gold sector, it'll happen big. I mean, you don't think stocks can go up by 10 times? I mean, look at Palantir, right? Went up 10 times from $7 to 70 in 6 months. That's a huge stock, right? Crazy how when capital gets directed into a certain area, especially gold and silver. How much things can run on the upside.
So, Bob, I think that's a perfect place to kind of bring in this time arbitrage idea and really let's say, looking out this 18 to 24 months, like, do you think, I hate to say it, but I've been told many times on the show, oh, this is the perfect entry point. What makes, right now any better than any time over the last 5 years?
Well, Larry talks a lot about the turn and how psychologically you have to trade differently, right? We are in a bull market for gold. We're getting higher highs and higher lows. It doesn't feel like it. It feels pretty crummy. But if you look at the charts, we're getting higher highs and higher lows. So we are in a bull market. So in a bull market, you buy the dips, you don't sell the rallies. And Larry talks a lot about in his bear traps report how in a bear market you can make a lot of money if you simply buy into capitulation and sell the rallies, but because it's going lower. But we're in a bull market now, so that's important for people to realize. We've been in a bull market for a few years, and it's just a lot of people don't realize it yet because there's another bull market going on too, right? But it is outperforming. Gold is outperforming the S&P, and I think that's the important thing to worry about. So you wouldn't actually have been behind the game if you had just been involved in gold rather than the S&P. You still would have been doing actually better in the last few years. So I think the people were right to say a couple of years ago was a good time to do it. When you listen to CNBC, they talk about the S&P. They don't talk about gold. So when people and your next door neighbor, Charlie Munger says the greatest motivator is envy, right? So when your next door neighbor is talking about, the AI stocks he's made money on the S&P, it's pretty hard to sit there in something that nobody's talking about, right? Even though you're actually doing okay.
I'd like to take a moment to talk about, let's say, the drivers for gold. We've seen, obviously, we already touched on China buying gold very aggressively. They kind of took a break last year from, I believe it was May to July, kind of came back into the market a little bit. But typically when we see rates getting cut, that usually acts as a tailwind for gold. But now that we see, inflation kind of picking back up, that's acting as a tailwind for gold as well. Explain to us a little bit about how you see, let's say, inflation and interest rates affecting gold right now.
Go ahead, Larry.
Well, okay, so this is very difficult for a lot of investors to grasp because there's two regimes, right? There's the 1965 to say 90 regime for gold, and then there's the say 1990 to 2020 regime, or to actually even say even further than that, where real rates have always been bad for gold. Not always, but right now in the last like especially the last decade. So if rates go up, that's been bad for gold because you can just put your money in a T-bill and get 5%. And so the last, especially the last 10 years, 15 years, investors are psychologically conditioned, have been. Now, what's happening is we're slowly transitioning back toward a 1968 to 1980 or 90 regime. It's happening slowly, but you can clearly see that gold is less sensitive to higher rates. And there's a whole bunch of reasons behind that. But what we need is for the general public to embrace this. You need higher inflation that's sustained, that people don't think it's coming back down. And people are still conditioned because the Fed gets up there in every Fed meeting and says, oh, long-term inflation expectations remain well anchored. And so when you have your wealth that's really being at risk by sustained inflation, so inflation really normalizing at 3 or 4%, staying there, then all of a sudden you go back to a 1968 to 80 regime where people need to own stocks and assets that have assets in the ground. You need to own gold mining stocks because gold mining stocks control gold in the ground. You need to own silver miners. You need to own platinum, palladium miners. You need to own natural gas miners. You need to own oil stocks because those companies own assets that are in the ground and that's going to help the investor offset sustained inflation. Now, the only way out of a $36 trillion debt hole, there's two ways out, and that's where we're in now. You can default, which Argentina's done a bunch of times, and there's been all these resets. It goes back to the Bible, the great debt jubilee. And that's the way civilizations have formed. There've been a lot of times there's been resets, and through civilization formation over time, there's resets and defaults. The other way out of a $36 trillion debt hole is to get interest rates below the rate of inflation. It's called financial repression. But the Fed has to do this very, 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 very slowly. Because if you do it too fast, you're going to really scare people. You create a crash. And so this Fed is trying to massage interest rates below the rate of inflation. That's why they just cut interest rates with essentially Atlanta Fed GDP at 3%. But we're still not at the point, this is what's frustrating for investors, we're still not at the point where the average investor wants to own companies that are in hard assets, because they still think, and most people still believe, that inflation is just going to normalize back to that magic 2% again. And that's good for growth stocks. That's why right now there's about 26 trillion in the NASDAQ 100, right? So people are still massively long financial assets, 20, 25, 26 trillion in the NASDAQ 100. But remember, once inflation starts to normalize at a higher plane, that's been happening over the last year, and once people believe that inflation is really going to be with us for a long time on a higher trajectory, then you see this massive migration of capital from financial assets, which are bonds and growth stocks, over toward other types of companies, your BHPs, your Valets, your Rio Tintos, your companies that own your Newmonts, companies that actually own assets in the ground that are going to protect you from sustained inflation.
And the psychology behind that, which is very important, and just reminded me of something Larry said years ago that I learned from this analogy. Larry said a strong bull is harder to kill than a weak bull, right? So the stronger the bull, the longer that bull has been remaining, the harder it is to kill that bull. So it comes at you, you hurt it, but it comes at you again, and you hurt it, and it comes at you again, and it keeps coming at you. But each time it comes at you, it's weaker than it was before, right? But it takes a long time to kill a very strong bull. And we've had a 40-year bull market of interest rates going down and inflation going down. So people have a hard time believing that that's the past. They think we're going to go back to that, right? So the bull keeps coming back at us. It's just weaker each time.
Yeah, and so look at NVIDIA, right? $3.4 trillion company. The entire natural gas. So natural gas is the only way NVIDIA can grow into that market cap is with a major reconstruction of the U.S. energy industry. All these data centers need spectacular amounts of power. Let me give you a stat. I was on a call yesterday with institutional investors, and one of the clients brought this up to me. So this is AEP, American Electric Power. This is their projection. It does talk about bull markets, right? This is their projection of data center and the demand for gas. They thought in 2022, looking out 10 years, they would need 1.5 gigawatts, okay? Looking out 10 years. And then in 2023, they thought it was 4.2. And then now it's up to 9 gigawatts. And so this is their projection of electricity demand, which flows into gas, it flows into obviously nuclear power. This is this is just blood curdling. Like this is such a colossal miscalculation from everybody in the AI game that's looking at all these AI companies on the hardware side, the software side, but nobody's looking at the U.S. power grid that's going to be needed to be reconstructed. Nobody's looking at okay, you're putting a data center in a community. That data center is going to drive up cost of electricity 25%. and the political backlash to that. You need small modular nuclear reactors to supply the electricity for these data centers. And so that's where you get into bull markets, like you're talking about, and the misconception of how you're going to get there. And that's where I think the opportunities in natural gas and natural gas equities is just off the charts bullish.
People on Wall Street generally don't care about commodities. They don't think about commodities. It's just not sexy, right? But energy used to be 20% of the S&P 500, right? I don't know what it is now, 3% or something like that. A very low number. But Robert Friedland one time, who was a great mining magnate, he said, sometimes I wonder where the guys on Wall Street think they got their ham sandwiches from. They think they got it from the fridge, right? There's no thinking about what has to be done on the commodity side to make this happen to this, right? And they haven't clued in yet. I mean, we've talked about uranium a lot. Obviously, the more press you see, the more positive things about uranium, the worse the stocks will do in the short run, again, because that's already factored in to the market. But you gotta look, and you gotta say, where are we going to get this power from? And with the green movement, we there's only one place, and that's really nuclear. But I think it pays really to be ahead of that power curve. I'm a pilot, and we talk about being ahead of the power curve. If you get behind the power curve, you can't recover, right? If you're ahead of the power curve, you're on top of things and you know what's happening. You got to be ahead of these things before people start talking about it in the press or on the other side of the ship, right? We originally invested in uranium stocks. We're 6 years into it now, right? When uranium was 200% below where it is right now, and our worst stocks are up 600 to 700%. Now everybody's starting to talk about uranium, and it's great. They'll probably do well. They'll probably have a big run going forward here. But again, being just a 2 or 3 years early, hundreds of percent. And I think that's going to be the case with energy going forward here. And it's going to probably be the case with silver stocks, because they haven't done that yet. Nobody's talking about them. And we're probably in that position where we're going to go crazy in a lot of these stocks over the next few years, but again, nobody's talking about it.
Yeah, and silver, you got the whole solid state battery. Battery technology is the key for a lot of this green revolution, electric vehicles, driverless cars, and so there's a lot of silver, rare earths. It's a tremendous bull case looking out the next 10 years in all these emerging technologies that are going to need hard assets or oil and gas metals to support this, the dream that's being presented.
But psychology is so important because people are unwilling to wait because they see their neighbor doing well in some of their stock right now. So they're unwilling to sit here and wait. And I always say, you can't control what's going to happen in the market. We don't know what's going to happen in the market. But what you can control is buying at the right time, paying the right price, and just being patient and letting the market come to you. Right. And Tom, we've talked about this before, but, one of the preeminent commodity people here in Canada is Eric Sprott. And he says, Bob, you got to sit in the room by yourself, having a party, buying stocks when nobody else knows that you're there or nobody else cares that you're there, and they're having a party in the other room. And he said, but when you have your full allocation and that room decides that it's time to party in your room, he said, it's an awful small door to get through, and the stocks go up dramatically. But you got to be there first. You got to be there when it's unpleasant, when it feels bad, when it churns your stomach. And that's what we're talking about. It shouldn't be churning our stomach right now to be in gold stocks. Gold's done great, right? But I think that gives us a fantastic opportunity to be here right now, and then just wait, forget all the noise, let the market come to you. And when it comes to you, it'll come to you fast.
Mm-hmm. Larry, you had mentioned this 2% inflation target that the Fed still has. And I just wanted to touch on that really quickly. Do you think that that's now the basement of their new average, and that they're going to, over time, come out and actually acknowledge that the new target is actually higher than 2%?
Well, what's interesting about this, Tom, is that we host lots of, you make about 10 times more on the speaking tour than you do writing the book. So we've been on this speaking tour for the last 16 years with the first book and the second book. and you meet a lot of incredible investors, a lot of academics. And so 2 years when this idea started to come out about the inflation target really massaging its way toward 3%. When you spoke to professional investors and academics, literally looked at you like you were insane. But even when you talk to really accomplished institutional investors, they were skeptical as well, many of them. But what's interesting is I just got back. We did a speech in Zurich, Geneva, New York, Miami, and we did ideas dinners. We talked to lots of different people that are talking about this subject around the inflation target. And it's very clear that more and more professional investors that looking out 10 years, 5 years, they're convinced that the Fed really has a phantom or an inflation target that's really up much more up toward 3%. Mm-hmm. But once again, they won't say this publicly. It's the type of thing that they won't say it right away. They're going to need to do, what they'll do is they'll launch 5 or 6 white papers on the subject and then slowly address this in Jackson Hole, in August, right? But they'll and you can see behind the scenes, and if you look closely, and Tom, and you guys look closely at the Fed speak over the last year, if you go through the speeches, and we have clients that they have teams that go through every speech, either using artificial intelligence or just using their memory banks, and you can see shifts toward a higher inflation target without officially acknowledging it's the policy. So again, at the end of the day, 36 trillion of debt, one way out, really, is you get interest rates below the rate of inflation. And one of the ways you do that is you slowly have a higher inflation target. And that in that world, that's a very bullish world for a 1968 to 81 type portfolio. 1960, where you're going to have a much higher. 1981, 50% of the S&P was in industrials, metals, materials, oil and gas. 50%, 50. Mm-hmm. That got down in recent years as low as, I think, 11, 12%. Are we going back to 50? No. But are we going back to, say, 25% of the S&P, 30% of the S&P in companies that own assets? Yes. And that gets back to that higher inflation regime from the Fed.
I think, Tom, it's interesting. It's a big picture again. Commodity cycles and stock market cycles don't overlap. They're opposite of each other. They usually last about 16 years. Interesting enough, there's a ton of reasons for that, which we could go into another time. But Larry just mentioned 66 to 81. There was about a 15-year period there where the U.S. stock market did nothing. It was flat. Had lots of ups and downs, but it was flat. But commodities during that time, we know what happened to gold and silver peaking at 50, copper, oil, 20 bagger. Tremendous bull market for commodities. Canada did relatively well. Then we got 82 to 2000. There's about 18 years again, 16 to 18 of the U.S. stock market just absolutely surged. Commodities did terribly. Then we got 2000. And then the U.S. stock market, people don't realize the U.S. stock market did nothing for 13 years, 12 or 13 years. We all think the U.S. stock market's never going to go down. It did nothing from 2000 to 2012. And we had a huge commodity run, right? Huge commodity run. Then from 2012 to 2025 here, 13, 14 years, right? We're starting to see the U.S. market's big. Commodities didn't do anything. We're right on the cusp of the next big run in commodities. And the U.S. stock market valuations right now at 22 PE shows throughout history that we have a 10-year forward-looking kind of return on the U.S. stock market of nothing for the next 10 years, for the next 10 or 12 years, right? We're not picking the day. Might be this year, next year, whatever the case is. But these valuations show a very little return for the market over the next 10 years as a market. And I think the market becomes growthier and growthier and growthier, right? So they keep changing the indexes. They're following the people who run the indexes are not leaders, they're followers, right? They're lemmings. So whatever stocks have done well, they're like, oh, I guess we'll make that one bigger part of the index. Well, you see, it becomes riskier and riskier and riskier the index. So what happens is the stock pickers tend to outperform very, very well when in these environments going forward, when the market tends to do well, because the whole market goes down, but your individual stocks, whether it's small caps or value, are something. And we talked about time arbitrage, but I think valuation arbitrage is a big one right now. We're invested heavily for clients and myself in a hedge fund that is very, very, very long defensives, low valuation stocks, and short all the high flyers. And I just think it's stretched to the point right now where that valuation arbitrage on a snapback is going to do extremely well. So lots of exciting things right now because we got lots of things out of whack.
Mm-hmm. Bob, you and I have talked before about this idea of cyclicality as well, but specifically in the mining shares. So explain to us quickly what the mining clock is and give us an update on where you think we are currently.
Yeah, the mining clock is basically a credit clock. Starts at 12. You can see the clock behind me. 3 o'clock, things are terrible. We're at the bottom. That was probably 2015. There's puking in the sector. No more private jets. CEOs getting fired. Debt reduction, et cetera. Companies almost going bankrupt. Remember, Glencore almost went bankrupt. And then you start to see at 4, 5, 6. You start to see a recovery. You start to see the underlying commodities start to do well. Companies are cash flow positive. They've reduced their costs dramatically, and they're starting to make money, and they're starting to try to increase their pipeline of new projects, right? So we're probably around 5 right now. They're different for different stages, right? Copper is probably behind gold, right? As far as the price is concerned. Then you start to get to 6 and 9, and that's when people start to be positive and say, hey, we're in a bull market. This is great. It's easy to get financing. They start to do more exploration. You're finding more projects, and money flows into the sector. And then 9 to 12 is kind of the danger time. That's when it seems too easy, too good to be true. And you start to get stock takeovers, et cetera. When that happens, it's time to flow out of the space, right? We're nowhere near that right now. There's no interest in the space. And actually, we moved back the clock from 6:30 back to 5 approximately. The reason we did that is because, there still hasn't been a lot of money flowing into the space. And I still think there's lots of opportunity. Part of that's a function of what else is happening in the market.
Excellent, gentlemen. Well, I really appreciate the discussion and the team aspect to really looking at all of these ideas. Is there anything that you'd like to leave our audience to think about before we wrap up here? Let's start with you, Larry.
The biggest thing is that one of the things we talked about in our first book was the years of the Bush administration into the 2008 election. If you look at what they did, there was a lot of massaging of the news and the data, the economic data. And as the economic data deteriorated, the Bush team kept putting a very, very deceptive kind of overlay pitch on it, and all of their pitch people in the media, their best contacts. And so that's why people got kind of like surprised, right? And so this applies to all different types of administrations. So when you go from a Democratic administration to a Republican, the GOP is going to control, all of these agencies, and now any games that were played on the labor market, any games that were played on inflation, the Trump team's going to out this stuff as soon as possible, and that's why you kind of had, like in 2008 to 9, Team Obama was like very, very aggressively showing people, what mistakes the previous administration did. Same thing with Reagan and Carter. And so I can't emphasize enough, as the Trump team takes reins across Washington on the 21st of January, they're going to really start to look at not just what Yellen did with all this T-bill issuance, in other words, issuing those short-term bonds. Remember, if the reason why she did that is short-term bonds don't move in price, right? So $2 trillion issued in T-bills doesn't move. If she had issued $2 trillion in longer-dated bonds, they would have moved like this in an election year violently, right? So she was not trying to rig the election, but she was trying So there's a lot of things with the labor market, with inflation, that you're going to see the Trump team immediately start outing these games. And that sets up a very different environment for investing. So I think that's one of the most important things looking forward.
And I'll say, Tom, I've got Larry's book myself. I have a lot of Larry's books for my clients that we send out to clients. And what's important there is gives a fantastic roadmap, I think, of the next decade. But importantly too, from these really big picture ideas, you got to have that down to a way to make money, right? In the short run. So there's a difference between being an analyst and a portfolio manager, right? Being an analyst is coming up with some great ideas, right? One-offs ideas. Being a portfolio manager is then taking those great ideas and sizing them properly in your portfolio, right? So sizing them in a way that if you're wrong, you're not going to lose a lot of money, but if you're right, you're going to make a lot of money, right? And that's an art to it. So I just want to say from that perspective, How to Listen When Markets Speak is a fantastic book. It gives a great pathway, a great roadmap. Then you have to say, okay, how can I make money from these ideas? How do I size my positions? How do I make sure that I have a good risk per unit of or return per unit of risk going forward here? And that's an art side of it too, and that's what we try to do with clients.
Excellent.
Thanks, guys. Appreciate it.
Gentlemen, thank you so much. It was an excellent discussion. Of course, for anybody that wants to hear more or read more of Larry's work, that's all available at thebeartrapsreport.com, at ConvertBond on X, as well Bob, miningwealth.ca, and Bob Thompson, RJ. Guys, thank you so much for your time today.
Great to see you guys. Thanks.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.